The Federal Reserve, or the Fed, is the central bank of the United States. It has a crucial role in the US economy. One of its main jobs is to set interest rates. Interest rates are like the price of money. They affect how much it costs to borrow money. When the Fed changes interest rates, it impacts businesses and consumers alike. The Fed's decisions influence economic growth. They also impact inflation, which is the rate at which prices increase. The Fed's goal is to keep the economy stable. It aims for steady growth and low inflation. The Fed's interest rate decisions are closely watched by investors, businesses, and consumers. They provide insights into the Fed's outlook on the economy. These decisions also signal the Fed's policy stance for the foreseeable future. In recent years, the US economy has faced several challenges. These include the COVID-19 pandemic and the war in Ukraine. These events led to supply chain disruptions and increased uncertainty. As a result, inflation surged to levels not seen in decades. In response to these challenges, the Fed initially kept interest rates near zero. This was done to support borrowing and spending. The goal was to help the economy recover from the pandemic. However, as inflation persisted, the Fed shifted its focus to controlling prices. The Fed's actions to control inflation have been closely monitored. Some economists argue that the Fed should do more to curb inflation. Others worry about the potential impact of aggressive rate hikes on economic growth. Since early 2022, the Fed has been raising interest rates. This is a tool to combat inflation. Higher interest rates make it more expensive to borrow money. This can slow down spending and cool off the economy. The Fed has increased interest rates several times. These increases aim to bring inflation under control. The Fed's target for inflation is around 2%. This is considered healthy for a growing economy. The Fed's actions have started to have an impact on inflation. However, it remains to be seen whether these measures will be sufficient to bring inflation back down to the target level. Section 4. Interest rates in 2024 and beyond. Predicting interest rates is, quite challenging. It depends on various factors. These include inflation, economic growth, and the job market. As of late 2024, the Fed has signaled its intention to continue monitoring economic data. It will adjust interest rates accordingly. Some economists expect the Fed to pause its rate hikes in 2024. This would give the economy time to adjust to the previous increases. Others believe that further rate increases may be necessary if inflation does not subside. The Fed's decisions on interest rates in 2024 and beyond will depend on how the economy evolves. The Fed will continue to strive for its dual mandate: price stability and maximum employment. Section 5. The impact on your wallet. The Fed's interest rate decisions have a direct impact on consumers. When interest rates rise, it becomes more expensive to borrow money for things like cars, homes, and credit card purchases. This can make it more challenging to manage debt. However, higher interest rates can also be beneficial for savers. They can earn a higher return on their deposits. This can incentivize saving and provide a cushion against inflation. Understanding how the Fed's interest rate decisions affect your personal finances is crucial. By staying informed, you can make better financial decisions. This includes managing your debt, saving for the future, and planning for large purchases.